Welcome back to The Explainer. Today, we've got a seriously fascinating paradox on our hands. Imagine a company that generates cash like a mature, super reliable utility company, yet its stock is down 35% from its highs. We're talking about Lyft. The numbers tell a story of a business that is, honestly, dirt cheap. But as we'll see, legendary investors like Warren Buffett might not touch it with a 10-foot pole. Okay, let's dive into this. To truly figure out what's going on, we are basically putting this stock on trial.
Here is how we're breaking down today's trial. First, the hidden value paradox. Second, four massive green flags. Third, the existential red flags. Fourth, the value investor scorecard. Fifth, the final verdict. And finally, number 6, the ultimate watch point.
All right, let's kick things off with Section 1, the hidden value paradox, and Wall Street's conflicting narrative. Now, this paradox is the main conflict that is literally tearing Wall Street in half right now. On one side, Lyft stock is trading at just 1.8 times earnings. In the tech sector, a multiple that low is almost completely unheard of. It normally screams buy. But on the flip side, Wall Street and the mainstream media are labeling this a total value trap. Think about the absolute absurdity of that for a second. A 1.8 times earnings multiple means the stock is priced cheaper than a fast food value meal, and yet the market is treating it like a toxic asset. So why the massive disconnect? Well, to answer that, we first need to look at what the analysts are completely ignoring.
Which brings us to Section 2, 4 massive green flags that the media just ignores.
Green flag number 1 is all about the cash machine. Look, analysts get totally caught up talking about top-line revenue, but they almost always ignore free cash flow. Lyft's trailing 12-month free cash flow represents a stunning 17.9% of its total market cap. Just to give you some context on why that is so wild, the median for the S&P 500 is a mere 4.2%. So Lyft is practically printing physical cash relative to its current stock price. And honestly, it gets even better with green flag number 2, a 22.7% owner earnings yield. Legendary investors absolutely love owner earnings because it tells you what a business actually puts into the owner's pocket at the end of the day. At this absurdly high rate, if you bought all of Lyft today, the entire business would essentially pay for itself in under 5 years, assuming, of course, the cash holds up. For a tech platform, a payback period like that is incredibly rare. Now, green flag number 3 is a brilliant strategic move. We'll call it the pit crew strategy. You see, everyone is panicking about Tesla and Waymo robotaxis stealing human-driven rides, right? But Lyft is actually positioning itself to become the low capital expenditure, maintenance, and charging backbone for these autonomous fleets. They aren't trying to fight the robotaxis head-on. They're building the service hubs for them. They're essentially pivoting to become Waymo's pit crew. It's a strategic masterstroke that almost nobody in the media is talking about. Finally, green flag number 4, international growth and partnerships. A massive 27% of their rides are now driven by integrations with partners like DoorDash and United Airlines, with the remaining 73% being standard rides. On top of that, Lyft finally bought FreeNow, which expanded them from a pure US player into 11 countries practically overnight. So the growth engine is absolutely still turning. Okay, so staring at all these incredible green flags, you really have to ask the obvious question, right? If Lyft is so remarkably cheap and printing so much cash, why isn't every hedge fund in the world piling into this stock? Well, the answer lies in the silent killers lurking on their balance sheet and deep within their business model. And that leads us to Section 3, the existential red flags, or, as I like to call them, the silent killers. The very first silent killer is a microscopic gross margin. We're talking 0.4%, not 40%, 0.4%. So the crucial point is that this paper-thin moat gives Lyft absolutely zero pricing power. None. If drivers demand just one single dollar more per ride, Lyft's entire profit evaporates instantly. In the investing world, a margin this incredibly thin means you aren't really a dominant tech business. You're essentially a utility fighting for scraps. Which builds right into our next red flag, geographic concentration. 90% of Lyft's business is entirely locked in the US market, with only 10% international. Uber, on the other hand, is a massive, sprawling global operation. So why does this matter? Because if autonomous taxis completely crush margins in the United States, Lyft has nowhere to run. They totally lack an international safety net. And the threats really don't stop there. Here are the final 2 red flags. First up, disintermediation. As Waymo scales up, why on earth would they keep sending their customers through the Lyft app? They can just build a direct-to-consumer app and cut Lyft out entirely. This isn't just tough competition, it's the total removal of the middleman, making Lyft obsolete. Second, the debt load. They're currently sitting at a 4.28 times net debt to EBITDA ratio, built up by borrowing money through years of unstable profits. Heavy debt combined with zero pricing power is the classic textbook signature of a value trap. And this brilliantly illustrates exactly why we need to call in the jury. Moving to Section 4, the Value Investor Scorecard. Let's see how this is judged by the greats. All right, here's the definitive scorecard, so we can see exactly how Lyft stacks up against the frameworks of the greatest investors in history. Let's start with the strict father of value investing himself, Benjamin Graham. Now, Graham loves a cheap PE, which Lyft definitely has, but he strictly demands a current ratio above 2.0. Lyft is a dismal 0.6, plus it lacks the required 5 years of stable earnings, so Graham gives it a hard F, a 24 out of 100, seeing this as a classic falling knife. Next up, Warren Buffett, the absolute king of the economic moat. Buffett requires a return on invested capital above 15% and gross margins above 40%. Lyft has a 2.8% ROIC and that terrifying 0.4% margin we just talked about. So Buffett grades it a D. He famously prefers a wonderful company at a fair price, and Lyft's total lack of a moat means he wouldn't even touch it. Finally, Peter Lynch, the growth guru. Lyft's 18.5% revenue growth actually fits his criteria nicely, but remember, Lynch only invests in what he understands. Because the autonomous driving endgame is so incredibly uncertain, Lynch grades it a moderate fit. The terminal value is just way too murky. This really brings us to weighing that massive cash pile against the driverless car threat to resolve this trial once and for all. Section 5, the final verdict, the heart of the paradox. Here is the absolute core of the paradox. Incredible current cash flow versus an incredibly fragile future. Look, the market isn't stupid. It's not simply ignoring that 17.9% cash yield. Rather, the market is terrified. Investors know that if autonomous fleets take just 30% of the rideshare market in the next few years, Lyft's massive cash yield drops to zero, instantly. The cash is very real today, but the future? It's hanging by a thread. So, here is the final verdict based on the data. If you're a short-term trader, Lyft is a very tempting bounce play. The 1.8 times PE and the current cash yield offer a real opportunity for a quick upside if the market sentiment shifts. But if you're a long-term investor using the Graham or Buffett playbooks, you need to stay far away. The margin of safety for a true investor isn't found in a cheap stock price. It's found in the durability of the business model. And right now, Lyft's long-term durability is severely compromised. But what if you still want to take the leap? That brings us to Section 6, the ultimate watch point. Looking ahead to Q2 2026. The management team at Lyft has set a very specific target, 18% to 21% gross bookings growth by Q2 of 2026. This right here, this is your canary in the coal mine. If Lyft hits this target, it proves their economic engine is still very much alive, and their pit crew pivot is actually working. But if they miss it, it basically confirms that Uber and autonomous vehicles are successfully eating their lunch, and the stock will likely head much, much lower. So we'll leave you with this final thought. Knowing the razor-thin margins and the looming shadow of autonomous robotaxis, are you brave enough to catch this falling knife? Or is it safer to just leave this battle to the robots?